One of the best investing charts you'll ever see, and you should get to know this, especially if you're going into retirement. I just love this. It's absolutely fantastic. So we're going to read my man Ron Sears and Ron Unz. Ron Unz, yeah, that's my guy. He's like where's Ron Sears and Ron Unz? Let me just look up Ron. Well, we'll go with this. I like whoever Ron Unz is. I like him. I remember. I just off the top of my head, I can't remember him. I like Ron Unz too. But this is Ron Sears over at Advisor Perspective. I love this chart. Details are provided in the following table. These are the return. Look, 1926 to 2021. This is where Dave Ramsey gets his 10 to 12% rates of return right here. 10.5%. 96 years. So if people say, well, we're averaging 10.5% for 96 years. That's a long time, Josh. We can sign, seal, and deliver a 10.5% average rate of return over the next 96 years. Maybe. The next 3 to 5, though, you better not flip and do that because that'd be stupid. That'd be stupid to assume just because we have an average 10.46% rate of return over the last 96 years that you'll get it because the average is on any given year. That's like a linear rate of return. And check this out, 48 years. So let's look at this. We only have two 48-year time frames. That's it. They're unique of the other. That's it. And this is why I love this chart. 1926 to 1973, 48 years. 9.33. The other is 11.60. Isn't that interesting? So we have one that's 11.60, which is 2.27 over 9.33. That's 24% higher the last 48 years than the first 48 years. Isn't that interesting? Oh, but then we also have inflation. That's 100% higher, basically. 3.87 over the last 48 years versus 2.03 over the first. So as you can see, we take 11.60 minus by inflation 3.87. Our real rate of return is 7.73. We take this right here, 9.33 minus inflation 2.03. Our real rate of return is 7.3. So point being is at the end of the day, this number is nominal before inflation, before taxes, by the way. But again, we only have two instances of 48 years. We have one instance of 96 years, two instances of 48. It's just not statistically irrelevant. It's irrelevant. Now we get 9 instances of 10-year track record. Each 10-year is unique of the other 10-year. This is what makes this so important. So I'm going to show you something. I did a live stream on this the other day. So I haven't been very consistent in my live streams lately. After the football's over, I'll get back to that. But we got the Bills and the Chiefs on right now. All right. So what everybody does is they'll use these rolling 30-year periods. They say for 30 years, rolling 30-year periods. And then what they'll do, if I can find, there we go. They'll say in 1926 to 1955, we averaged, 13%. In 1927 to 1950, 1920, I wrote 1292. 1927 to 1956, we averaged 12.92% or so on and so on. So they'll use these 30-year rolling periods. I think there's 84 or 54, I can't remember, 30-year rolling periods. And they'll say, look at that. So for every 30-year rolling period, we've averaged over 10%, whatever. I'm like, that's completely irrelevant. Statistically, that's not relevant. And the reason is because from 1926 to 1955 and 1927 to 1956, 29 years are the same. Statistically irrelevant. 29 out of 30 are the exact same. The only difference is like 3.3%. Only 1 year out of the 30 is different from the previous 29. All the other 29s are the exact same. They fall in both categories. It's statistically not relevant at all. So you can't use rolling time frames. It doesn't mean anything because they're so statistically similar. That's not statistically different. So I know I hate to keep hashing on this, but the N, if you look at the N, which is the number in the sample size, the N for the whole, essentially basically modern era, is 1. The N for the 48 years in the modern era is 2. Not statistically relevant. I think it's got to be like 35 or something like that to make it statistically significant, to have an N. Someone in statistics will remind me in polling, I think it's got to be a sample size of at least 35, something like that. Yeah, maybe that's diversification. I think statistically relevant on a poll has got to be over 100. Either way, but here we got nine 10-year time frames. All right, from 1932 to 1941. I don't know why they didn't do from 1926. I don't know, but anyway, it would have been because we want to have the end of 2021. I got you. 1932, we only averaged 6.3%, 6.4%. But look at this, we had no inflation. So basically, we were at 5.8 there. Here we're at 12. Here we're at 15. Here we're at 4. And here we were at negative. So 1972 to 1981, 6.47 was our rate of return, but the rate of inflation was 8.63. So here we lost 2% a year. So show me again the hedge against inflation stocks. Inflation averaged 8.63 in that decade, and we only averaged 6.47 on stocks. So stocks are a hedge against inflation. No, they're not. Stocks, I tell you, man, stocks are a hedge against slow, consistent inflation, the federal funds target or the Federal Reserve target of 2 to 3%. Anything that rocks the boat, stocks are not a hedge against, and that could be on inflation or deflation. How about Japan? 1982, 1982 to 91, 17, 13, 2. All right, so in 2002 to 2012, we basically only made money. Was that 28 basis points, and then 2012 to 2021, again we kicked butt, took names. So we have 14% here. We actually did better in 2012 to 2021 than we did in any other decade except right here, 1952 to 1961. That's it. So we have 9 independent sequences here, and the one we just lived through, 2012 to 2021, is the second best performer of all, net of inflation. Interesting. What does that tell you? On top of that, we've had 1, 2, 3, 4 that we had less than 7, basically less than 7%, and his net of inflation is certainly less than 7%. So we've had 4 that we had net of inflation less than 6, negative. Yeah, so we've had 5. 1, 2, 3, 4. 4 of the 9 times, or roughly was that 45% of the time, we had less than 6% real returns. So now on the other hand, we've had 1, 2, 3, 4, 5. We had double-digit real returns. So I can't stress this enough. So instead of looking at like this, the average return has been 10.46 because that would be stupid. 10.46 is the average. That is correct. But let me check this out. 4 of the 9 decades, 45% of the time, is less than 6%. 55% of the time is over, that's about over, we'll say 12, something like that. You see what I'm saying? So quite a big divergence. That's a less than sign. That's a greater than sign. 45% of the time is less than 6. 55% of the time is greater than 12. And it might even be more. I don't know. But anyway, the point being is the 10 to 12% average rate of return thing is just stupid, man. I hate to say it. It's just dumb. Because on any given year, it's not going to be 10 to 12%. In fact, if we go up to this chart right here, you can see. This is stocks right here. We got 10 to 12. Well, we actually have 10 to 20 is the biggest return of any given time. 10 to 20, not 10 to 12. And I don't even know how many that is. So if you go back to 1926, your returns have been between 10 to 20 more than any other return scenario. In fact, 10 to 20 and 20 to 30 are the 2 largest returns that you've had in your entire investment history going back to the modern era. And then 0 to 10. All right. Now, with that said, we got 1, 2, 3, but you also have 3 years: 0 to 10, 10 to 20, 20 to 30. The top 3 of the numbers here. 3, 4, and 5 were negative 0 to 10 and negative 10 to 20. I hope that makes sense. So then going back to the question again of what I had is, where are we on this chart? Are we in the, going forward, are we going to be in the low 45% of the 10-year time frames, or are we going to be in the high? Well, here's the way I look at it. From 1932 to 1981, we had 5 different unique 10-year time frames. 3 were poor. Negative in 1972 to 1981, 4% real from 1962 to 1971, and then about 6% roughly, give or take, from 1932 to 1941. So 60% of those 5-year times, we were not doing great. That's for doggone sure. Now, 40% we're kicking butt and taking aim. All right, now the question is, what are we going to be doing going forward? We've had 3 stellar decades, 80s, 90s, and the teens. And we've had those sandwiching in this one horrible decade, which we actually made no money, basically, from the aughts. So what's more likely to transpire? Well, the reason why these has changed because we have globalism, free trade supposedly. We've had, the economy's have been felled. Capitalism has taken over, where this is all Keynesian here, capitalism. Look, but we could also say, but we've taken on so much debt. I mean, I was listening to my man Simon over at Uneducated Economist. And I was glad to hear him say that the government's been printing. He said the government's been printing money since 2008. Nah, dude, the government's been printing money for a hell of a lot longer than that. But at least he acknowledges it's not just like the last 2 years the government's been printing money. I mean, look at what funded Medicare, what funded the Vietnam War, Nixon, Reagan building up the space defense thing. The government's been printing money like a drunken sailor since the late 60s. All right, so then you say, okay, so what has caused this growth? Is it the government printing money on top of the open of globalization? Yeah, absolutely, both. 100%. Can that continue? No. At some point, you can't keep just printing money forever and ever and ever. And now, when I say you can't, I mean maybe you could. I don't know. It's an experiment never tried before. And when you talk about Weimar Germany or Venezuela, that's complete nuts, man. We just look at the history of those two things. It's not the same. The question is, can you? We don't know. At the end of the day, at some point, you can't keep printing your way to prosperity. It's kind of like you can't tax your way to prosperity. I completely agree with that. But at the same point is, we don't know when or how the money printing will stop. Everyone says you can't. Well, why can't you? Weimar Germany. Okay, well, that's not really what happened, is it now? Venezuela. Not Bolivia, Zimbabwe. Not the same thing. Just do some research. Now, the question is, can we keep getting cheap labor, globalization, cheap goods, shipped back and forth? And I don't think we can anymore. I think now that China has got their taste of success, India is getting their taste of success. They don't want to be bullied by World Economic Forum types in the West. It's not going to be the same. I mean, maybe for another decade, I don't know. But what I'm saying is, I'm putting my faith, or by gambling, my whatever they call it, Las Vegas, the tickets, whatever, the coins, whatever, that we're going to be more like this. Then we're going to be like this, 100%. And so because of that, that's why I use a 6.5% for stocks, 2% for bonds, and a 2% inflation. Now, I will change. Vanguard changes their numbers. Federal Reserve Board will change their targets and all that. But I'm not changing to anything like a double digit. It's nuts. All right, so then we go to 5-year time frames. All right, so this is the retirement risk zone, if you will. That's what Ron calls it. Basically 2.5 years before retirement, 2.5 years after retirement. 1, 2, 3. We've had 3 negative returns, just nominal, before inflation on 5 years. All right, so we have, I think it was 19. We had 19 5-year time frames. All right, so 3 were negative. 3, I should say negative. I'll do neg 3. Then we had 1, 2, 3, 4, 5. What's that? Less than 10. All right, so 8 out of 19 were negative or less than 10. All right, so we take our trusty calculator, 8 divided by 19. That's 42% of the time. Again, basically 40 to 45% of the time we have bad returns. 50 to 55%, 55 to 60% we've had phenomenal returns. But then if you factor in, let's see, and then look at 22%, 20%. So let's go to greater than 20. I just don't think that's likely to happen again anytime soon because we just went through an enormous decade. 22, 1, 2. We've had 3. I guess that's, I'm going to call that 3. We've had 3 of greater than 20. All right, so of the 19, 11 have been negative, less than 10, or greater than 20. Right there, it's the only 10% one we've seen right here. So going back to 10 to 12%, the only one we've seen between 10 and 12 is this guy right here. So 1 of 19 hasn't been 10 to 12%. But remember, the average is 10 to 12%. It's 10.46. And only 1 of the 19, which is a percentage rate of, what's that, 4%, 6%, 5.2%. That's it. 5.2% of the time have we been between, in any given 5-year time frame, 10 to 12%. And then we go to, I think, does it got 1? Yeah, he doesn't have 1 years on here. Anyway, the point being, these are all unique 5-year time frames. That's why I love it. We already talked about it's the worst time to retire. Whatever. I just love that. Now that's just, I don't care. Like standard deviation, the average is 18.62. So if we go down to the last, is 13.1 over the last, look, 18.62 historically. The first 48 years are 21.43. The last 48 years are 15.31. I would suggest because of the wars, obviously, of World War II, but I also suggest because we've had leverage, LBOs and things of that nature, that heavily leveraged, but that did reduce standard deviation for sure. And look at that, the depression, 35%, you know what I'm saying? But basically you can see a standard deviation historically, 13, 12, 13, 15, 16, 14, 15, 16, 13. I would say a standard, if you got rid of the depression time, standard deviation, probably on average about 14 to 15, I'd say 15 is probably, 14 is probably spot on. So that was just an outlier right there. And then, but I mean, look at these standard deviations, 29 and 40. And then look, it's all kind of gone back a little bit. So basically get rid of these first 3 5-year time frames, and standard deviation runs about 14 to 15, what I'm saying. And then we got inflation right here, 2.95 has been the average, but some years we've had deflation. Some 5-year times we've had double-digit inflation and high inflation. Other than the last year, we've had low inflation, the deflationary time frame because of demographic shift. Anyway, so good stuff. I love that chart. I think you should look at it and recognize when people start saying, well, never in the history of the stock market, at any given 30 rolling year time frame or 20-year rolling year time frame, it's irrelevant. I just say, okay, talk to the hand. I'll see you later. All right. Love your thoughts. We'll see you.